Well, to unpack the overnight moves on the back of the Fed's decision to keep interest rates on hold, I'm joined by Kyle Rodder from Capital.com. Kyle, a new era ushered in here and getting rid of forward guidance.
Yes, and potentially a lot of other things as well. So, I mean, the statement was cut practically in half. The press conference had far less color than what we have been used to with previous Fed Chair people. And there's this sort of task force now, or five of them, that looks like it's going to potentially overhaul a lot of what the central bank does. So, there was sort of, I guess, two layers of these things here. There was kind of the, institutional and potential structural reform, which could have a very big influence on how policy is enacted, going into the future. And then there was that outstanding question of, where to next for policy and, what is Kevin Warsh like as a chairperson? And it would appear maybe slightly hawkish. So it was a pretty jam-packed and loaded decision, certainly press conference in terms of, all the changes that we're confronting now. And I think it's only natural that we saw markets coming off on the basis of a little bit of that uncertainty and then, of course, that hawkishness that we did see.
Yeah, interesting. I read your morning note as well. You're talking back to when Kevin Warsh was quite hawkish back in the 90s and saying that, a hawk can't lose his feathers, perhaps.
Yeah, without a doubt. I mean, I think that was probably the key issue that everyone was asking going into this meeting. I mean, I think everyone was kind of blown away by how bold maybe some of the ideas were that Warsh put out there on his first press conference and first meeting as a chairperson. But going back to really what the markets were looking for was, is this the Kevin Warsh that was rather dovish and ostensibly, sort of campaigned with quite a dovish policy bias to be able to get the job or the nomination from President Donald Trump? Or was this going to be the Warsh that, seemed to be a little bit more authentic, the one that was far more hawkish in the noughties and through that sort of GFC era, and very much more a sort of, an inflation-focused central banker? And I mean, I think there's a number of things you could say about what a Kevin Warsh Fed might look like. Some of those things are obviously still being formed with these sorts of task forces. But he wants a minimalist central bank. He wants a central bank which intervenes a lot less in the markets. And he wants an inflation targeting central bank. And the overarching takeaway there is that he is still a hawk, that this Fed is going to be focused on inflation, and that as a result, rates could be moving upwards in the not too distant future.
And Kyle, the other thing that's happened in the last half hour or so is the US and Iran signing this memorandum of understanding, a really positive sign here that we may finally see the reopening of the Strait of Hormuz.
Yes, and I guess the issue now is to what extent is this fully priced into the market, or whether there is more downside to come in the oil price. I mean, I think it's noteworthy just from a sort of charts perspective that we're right on the 200-day moving average now for, the price of West Texas, and, it extends almost a 20% drop in the space of a week and a half. I mean, the development itself is obviously incredibly positive. It gets the global energy market back on the path to normalization. It probably diminishes some of the urgency for many central bankers to hike interest rates. Of course, the ECB moved interest rates higher last week, really on the basis that they were concerned that the energy shock was leading to sort of a broadening out of inflationary pressures, and they had no choice but to lift interest rates. It's also obviously something that will be a tailwind for economic growth going forward as well, and hopefully take maybe some of a headwind away from the cyclical areas of the market, which were, of course, underperforming some of those, AI names, which were more or less outperforming for most of this year, certainly on Wall Street and other parts of Asia as well. But once more, the issue for the markets is, first, is this fully priced in? And is this the best that we can expect from, the move in oil prices from here? And then we've got 60 days of negotiations around that critical issue, around issues around uranium enrichment and Iran's nuclear industry. And there is still the risk that negotiations do sour, things do fall apart, and we end up in another precarious and uncertain situation. So this is kind of a matter of, maybe the beginning of the end, but it's certainly not, the end of itself with this peace deal.
Indeed. All right. Well, let's put all this together. It's looking like a negative start for the local market. What I guess is continuing to drive sentiment as we're heading towards the end of the financial year.
Yeah, certainly. I mean, I think that we've probably got a little bit more of this risk aversion in the market as markets reprice Fed expectations. That probably has a little bit more legs. But on the flip side, obviously, as we know, the Asian region has been very, very sensitive to the geopolitical developments and the volatility in oil prices, and the fact that we might be seeing, again, the beginning of the end of this war is going to be something that hopefully provides some support to risk assets across the region, the growth prospects across the region as well. I just sort of flag that even if we do see a little bit of volatility in equities today, we've got obviously the dollar moving higher, yields moving higher, the Japanese yen in a very interesting intervention zone once again that could sort of spark perhaps moves from the Ministry of Finance over there once again to try and get the currency back under control, because obviously the dollar is lifting. But overall, I mean, again, we're dealing with some major cross currents here, a world that's probably going to see interest rates move higher in the not too distant future, the urgency of which has probably been diminished by these geopolitical developments. But for now, the uncertainty alone is probably going to see a little bit of risk aversion throughout the Asian session, albeit within what I think is still probably a fairly constructive backdrop for equities once we sort of manage to price some of these things in and move past the sticker shock of that interest rate uncertainty in the United States.